Yeah, thanks very much, Scott. Charlie Evans saying that a 50 base point hike in September is, quote, reasonable. 75 could be, quote, okay. But he goes on to say that he doesn't think more than 75 is needed. Says policy can change if the economy is in recession. But overall, the Fed is working towards or at a neutral rate. And he says it has to go to a restrictive rate over time. So this idea out there, I get a little pushback, Scott, to this general in the bond market that the Fed is done and going to cut deeply next year. San Francisco Fed President Mary, our own John Fort, that the Fed's work on inflation is, quote, nowhere near almost done, and the inflation numbers are far too high. She said she has been trade in the bond market. Obviously, Scott, we kind of expected, as we talked about this last week, that this idea that the Fed had pivoted, there is now a kind of pushback by the Fed or by some Fed officials that some kind of imminent or early 2023 rate cut is in the works here.
Although 50 in September being reasonable, he could have said, well, 75 seems more reasonable. He did not. He used the word reasonable around 50. Where does that jive with where Evans has generally stood? Are you surprised at all by the remark, or no?
No, I think Charlie is one of the more what do you want to say, cautious rate hikers out there. He's on board with raising rates, with the overall thrust of Fed policy to fight inflation. But he wants to go, I think, among the Fed members a little bit more slowly. I think he's right with the center of the board right now. That's probably, depending upon that inflation report we get next week, in line with a 50 right now. But that could change to 75 if we do, say, double digits, and we don't see any of the commodity price declines we've seen, Scott, show up in the CPI. Some sense right now that maybe we've reached that peak inflation and that it will come down. But remember, Scott, the number now is 9. The number we got to get to is 2. There is a long way to go, and I think Mary Daly's reflecting that, and I don't think Charlie would disagree either. Yeah, Steve, I appreciate it. Thank you for those breaking headlines. So, Stephanie Lake, sure. Look, not to make too much of incremental moves, but the incremental moves that we have gotten since these Evans headlines have crossed are incrementally more positive. I mean, if you want to say it that way. Stocks coming off their, the levels that they were at when we started the show, yields ticking a touch lower on that. I mean, it just goes to how we're trying to game what we're supposed to do, whether the risk-reward scenario is, in fact, better for investors, as Marko Kolanovic, which we're really playing off that note that he dumped during our show yesterday. But it's the central question.
I mean, look, I think we're going to remain very choppy in a trading range. I think there are positives and I think there are negatives. And I don't think you get too euphoric and I don't think you get too negative, right? So on the positive side, inflation is starting to come down. If you look at energy prices, food prices, the prices paid index yesterday from the ISM manufacturing dropping 18 points, the lowest level since August 2020. That's very encouraging. We're still really too high, though. As Steve just mentioned, we're at 9 in CPI. We have to go to 2. So those are the things, though, that we're watching. But we are making some progress. On the negative hand, we don't know what the Fed is going to do. We don't know what they've already put in place and what that's going to lead to in the economy, because there's a lag effect. And also, we also know that the economy is slowing, and it's slowing faster than expected. So I think August and September are typically very choppy months in general. I think this year is no different. On one hand, earnings are holding up, and actually I'm encouraged that we're not even seeing a lot of companies lower guides. So that's good. I think that some of the stocks that I'm looking at are down a lot, 20-30%, discounting a lot of bad news. And so I don't want to get over my skis in terms of sector overweights or underweights. I want to be balanced, but I am looking for opportunities when the market's correct. You don't have to chase in this market. Yeah. So, Joe, 10-year, 270, moving a little lower, 260. At what point are falling bond yields a problem? Because right now it's the view of, oh, bad news is good news, because then it keeps the Fed from being as hawkish as people thought they were going to be. But at what point do you start seeing the alarms go off about falling yields and what that really means in terms of a recession?
Well, my view has been that we're in a recession, and I'm of the view that bad news is good news. We're combating inflation. We don't want to pivot. You don't want to buy the market because you think there's going to be a pivot. You want the Federal Reserve to remain committed and disciplined in continuing to normalize rates higher and to enact balance sheet tightening. So bad news is good news, and an economic contraction is the price that because
How
the
is bad news good news? You want a
economic
recession? Do we want a recession? I mean, is the market priced for a recession now?
Yes, the market's priced for a recession right now. It's not priced for a deep recession. And I'm sorry, but an economic contraction and a slowdown in demand is the price you pay for normalizing the ridiculous abnormalities of the last 2 years in the economy, for the accommodative monetary policy, and for the stimulus. You have to weaken demand to combat inflation.
Yes, you do, but you're assuming that the Fed can thread the needle. Well, why do they deserve the benefit of the doubt that they can, in fact, do that?
So as an equity investor, the comfort that I get is that 319 S&P companies have reported. We've got 14.8% revenue growth and 6% EPS growth. There's resiliency. Consumer spending is strong. Tonight, you're going to hear from Starbucks to get a further glimpse into what consumer spending is like. Chipotle told you consumer spending is strong. So the consumer and corporate environment is going to be the ones that are going to buffer a much deeper economic contraction. I'm not relying on the Federal Reserve for that. What I want the Federal Reserve to do is to respond to the inflation by staying committed to further tightening policy.